Hi guys, welcome to my channel. Before we get started, make sure to hit that like button. Also subscribe to my channel. Understanding credit scores and how to improve them. So make sure to watch the full video. Credit scores are an important aspect of personal finance. They are a numerical representation of an individual's creditworthiness and are used by lenders to determine whether or not to approve a loan or credit application. A good credit score can mean the difference between getting approved for a loan with favorable terms and being denied altogether. In this blog, we'll take a closer look at what credit scores are, how they're calculated, and how you can improve your credit score. What is a credit score? A credit score is a three-digit number that represents an individual's creditworthiness. It's based on information contained in a person's credit report, which includes things like their payment history, credit utilization, length of credit history, and types of credit used. The most common credit score used by lenders is the FICO score, which ranges from 300 to 850. How is a credit score calculated? Credit scores are calculated using a complex algorithm that takes into account several different factors. The exact formula used to calculate a credit score is a closely guarded secret, but we do know the basic factors that are taken into account. These include payment history. This is the most important factor in determining a credit score. Lenders want to see that you've made all of your payments on time and that you haven't missed any payments. Credit utilization. This refers to the amount of credit you're using relative to your available credit. Lenders like to see a low credit utilization, as it indicates that you're not relying too heavily on credit. Length of credit history. Lenders prefer to see a long credit history, as it provides a more complete picture of an individual's creditworthiness. Types of credit used. Lenders like to see a mix of different types of credit, such as credit cards, auto loans, and mortgages. This indicates that an individual can handle different types of credit responsibly. New credit. Opening too many new credit accounts in a short period can be a red flag for lenders, as it may indicate that an individual is experiencing financial difficulty. How can I improve my credit score? If you have a low credit score, there are several things you can do to improve it. Here are some tips. Pay your bills on time. As mentioned earlier, payment history is the most important factor in determining a credit score. If you have a history of late payments, it's important to start paying your bills on time. Keep your credit utilization low. Try to keep your credit utilization below 30% of your available credit. This means that if you have a credit card with a $10,000 limit, you should try to keep your balance below $3,000. Don't close old credit accounts. Length of credit history is an important factor in determining a credit score. If you have an old credit card that you no longer use, it may be tempting to close the account. However, doing so could hurt your credit score. Apply for credit sparingly. As mentioned earlier, opening too many new credit accounts in a short period can be a red flag for lenders. If you're looking to apply for a new credit card or loan, do so sparingly. Check your credit report for errors. Mistakes on your credit report can hurt your credit score. It's important to check your credit report regularly to make sure that all of the information contained in it is accurate. In addition to these tips, there are also some things you should avoid doing if you want to improve your credit score. These include maxing out your credit cards. This will increase your credit utilization, which can hurt your credit score. Applying for too many new credit accounts. As mentioned earlier, applying for too many new credit accounts in a short period can be a red flag for lenders. Ignoring your credit report. Your credit report contains important information that can affect your credit score. It's important to check it regularly and dispute any errors. Making late payments. Late payments can hurt your credit score. If you're having trouble making your payments, reach out to your lender to see if you can work out a payment plan. Closing old credit accounts. As mentioned earlier, the length of credit history is an important factor in determining a credit score. If you have an old credit card that you no longer use, it may be tempting to close the account. However, doing so could hurt your credit score. It's important to remember that improving your credit score takes time. It won't happen overnight, but if you follow the tips outlined above, you should start to see an improvement in your credit score over time. How can I monitor my credit score? There are several ways to monitor your credit score. One of the easiest ways is to sign up for a free credit monitoring service, which will alert you if there are any changes to your credit report. You can also check your credit score for free once a year from each of the three major credit bureaus, Equifax, Experian, and TransUnion, at annualcreditreport.com. There are also several paid credit monitoring services available that provide more frequent updates to your credit score and credit report. These services can be helpful if you're actively trying to improve your credit score. How can improving my credit score benefit me? A higher credit score means companies see you as a lower risk, so you're more likely to be approved for credit. This is because a high score indicates you have a history of managing your credit responsibly, such as making any repayments on time. The benefits of improving your score may include better chance for a credit card, mortgage, and loan approval. Whether it's a loan, credit card, or mortgage you're after, a higher credit score means you'll have a better chance of being approved. You may also be able to choose from a wider range of credit offers and providers, which can help save you money. Lower interest rates. If lenders think you're a lower risk, they may offer you better interest rates on loans and credit cards, which can make borrowing cheaper. A good credit score can improve your chances of being approved for a low-interest loan or a 0% spending card, for example. Better car insurance rates. If you choose to spread the cost of insurance over a year, your credit score can affect the interest charges you pay in addition to your insurance premium. Higher credit limits. If you improve your score, you should have a better chance of borrowing larger amounts. This can help you achieve goals faster, such as buying a new car or making home improvements. 4 tips to keep your credit score healthy. Limit credit applications. Applying for credit frequently in a short space of time can make lenders think you're overly reliant on credit and therefore a higher risk. It doesn't matter what form of credit you apply for or how much you're asking to borrow. Each application will record a hard search on your report, which companies can see. So try to space out any credit applications. A good rule of thumb is no more than one every 3 months, but remember lenders' criteria can vary. Avoid defaulted accounts. Defaulted accounts usually occur when your relationship with the company has broken down, usually because you've missed several expected payments. Defaulted accounts can have a significant impact on your credit score. Only borrow what you can afford. Getting into trouble with debt may lead to things like county court judgments, CCG, and individual voluntary agreements, IVA, or even bankruptcy. These things will stay on your credit report for at least 6 years and will have a significant negative impact on your credit score. Keep an eye out for fraudsters. Keeping a close eye on your credit report and looking out for any signs of fraudulent activity could help protect your credit score. If you see a surge in the amount you owe or any applications you didn't make, you may be a fraud victim. Note that if you do become a victim of fraud, your lenders should fix any damage to your credit report quickly once they've investigated and established the facts. We can help you correct your credit report following fraud if you get in touch. Conclusion: your credit score is an important aspect of your finances. It's used by lenders to determine whether or not to approve a loan or credit application and can have a big impact on your financial future. If you have a low credit score, there are several things you can do to improve it, including paying your bills on time, keeping your credit utilization low, and checking your credit report for errors. By following these tips, you can improve your credit score and put yourself in a better financial position. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go.